Hey, can you guys hear me? Can you hear me? Okay, thanks, Scottson.
Yes, yes.
Okay, all right. Sorry, I had to. All right, guests are coming. Okay, good. So it looks like we're getting it. I think I made a little mistake. I had to recreate the space. Um, so anyway, but we're good. Okay, we'll just give it maybe one more minute here and see who else is going to get in the space. So it's three now. So 3:01. We'll start speaking, I guess.
Is that link that you sent earlier still
Yeah,
functional or
I guess so. I think what happened is I apologize. I think I had to add you as a co-host first, and it wouldn't let me do that, so I had to cancel it. You know what I'm saying? So
okay.
so I think that's what happened. So I didn't know that. I mean, okay, but we're getting all right. 12 people. Okay, Scott, are you ready to start? Or
Yeah, yeah. I was gonna retweet that link.
okay, yeah. Go
So
ahead.
I just want to make sure it worked. Okay.
Yeah, go ahead. I retweeted.
Okay. Great.
Okay. All right. We got 13, 14 guests. Okay. So like this is good enough to get started. All right, everybody. Thanks for coming out and joining us on this Twitter space. If it doesn't work, blame Elon. Uh, anyway, and I want to say thanks to Scott Patterson for doing the spaces with me. I really appreciate it. This has been a subject I was really interested in, and I had no idea he was writing a book on it. Um, Scott's a reporter for the New York, for I'm sorry, for the Wall Street Journal for quite a bit of time now, and his older books are Dark Pools and The Quants. So if you are interested in trading and finance, those are something you guys should also definitely listen to, or I'm sorry, look up and read. And a fun fact about the Quants, which I've read, one of the main characters in the Quants would be a guy named Jim Simons, who actually has made his money, I would say, the exact opposite way of the people we're profiling in Chaos Kings. He's made his money by a lot of frequent trades and small and little small winners. And the guys in Chaos Kings are making their money, like Nassim Taleb or Mark Spitznagel, very infrequently for really big sums. So fun kind of little anecdote about that if that's something that interests you. So I'm James Marsh. I'm an options trader out of Chicago. I've been involved in the futures industry for a while. My father was in it. My dad was a pit trader for a long time. And fun fact, when I was in high school, I believe actually I was working at the Board of Trade floor as a runner when I think Mark Spitznagel, who now runs Universal Investments, was a young guy trading in the bond floor, in the bond room, and having the most famous trader in Chicago at the time shoot spitballs at him. And his name was Mark Baldwin, Tom Baldwin, sorry. Okay, so uh, let me. Uh, crap. What did I? Okay. So let's ask Scott if. I'm sorry. One second.
Hey,
Yeah.
James. Yeah, a little bit of technical difficulty. I keep getting muted, but
Okay.
right.
Can you can hear me
Okay.
now, right?
Yeah, yeah,
Okay,
yeah. I
and
can
you can
hear
speak.
you.
Okay.
Yeah.
All right. So let's talk about perhaps the beginning of the book. And the book, of course, goes through a lot of subjects. I mean, we start off like with some of the most famous traders like Nassim Taleb and Mark Spitznagel, and then we talk about some other another guy named Bill Ackman, who was a famous hedge fund manager out of New York.
Right.
And then we talk about another guy named Diedre Sornette, who is kind of an academic, I would say, in a certain sense, and they all have different approaches to uh, risk risk management, and making money in the market. So I just want to ask you, since you know them all a little bit, do you think that there's
Mhm.
any chance? Do you think there's anything they all can agree on together?
Yeah, I mean, I think that they. Can you hear me? I just want to make
I
sure.
can hear you.
Okay. Okay. Yeah, I mean, I think they would all agree that the market is characterized by extreme events. The opening chapter, uh, Hell is Coming, which is the Bill Ackman story of his COVID-19 trade. He talks about how the risk of the pandemic is exponential and about how he had learned to think exponentially by observing financial markets, um, going through extreme periods like 2008 and other extreme, semi black swan like events. That's Didier Sornette, who, yeah, he's an academic. He also has been extremely involved in financial markets and researching financial markets for decades. And in the 1990s, he helped found a hedge fund that went on to be one of the most successful European hedge funds, called ETH. Or sorry, it's Capital Management Group. He created his black swan like monster is called a Dragon
Mm-hmm.
King, and it's like a black swan, but according to Didier, it's predictable, and using some complicated mathematics that he actually had discovered in the 1990s, trying to figure out how to detect signals of bombs exploding or rockets exploding. He used that to try to detect these Dragon Kings in the markets, and so he was, been doing lots of experiments, trying to prove that these things are predictable. I would say that from looking at what's publicly available about those predictions, they meet with some success, but not always. What seems to be very tricky in detecting bubbles, which is what he's attempting to do, is detect a bubble before it explodes, is figuring out when that explosion is going to happen. So he does seem to have some skill in predicting assets like commodities or indexes or stocks that have showing bubble-like characteristics. The trick is figuring out when it's going to come to an end, and that's very hard. And so that's what's somebody like Mark Spitznagel or Nassim would say is the problem is that predicting these things is nearly impossible. And while they agree that the market is characterized by these very extreme fat tail events, you can't predict them, and that's what gives the characteristic of the universal hedge fund its unique properties. Is it does not need to predict anything, because it's constantly maintaining this overlay of crash protection that they provide to clients. So there's no predictive element in it at all. It's not speculating, except to the extent that they do they do predict that there will be these big events, and that if investors put a small part of their portfolio into the University Fund, it will help protect them. But they make no claims about timing the market at all.
Okay, so I would say that's one of the biggest problems. If you're taking risks, is trying to predict and trying to calibrate a response that's going to protect you, right? And these are what all these guys are essentially trying to do: protect against risks and get a good payoff. But let's talk about the last guy, Bill Ackman, who is in New York, and he has probably a third approach, right? Which I would say is the most traditional approach, and that is I sort
Hmm.
of see a crisis coming and I'm going to throw on a trade. Does that sound accurate?
Yeah, I would say, put it simply, yes, that's what he does.
Yeah. So we have three different ways of looking at things, and I would say that we're dealing with three different personalities. I suspect are not really going to get along, and I guess that's kind of what makes the world go around is a bunch of people with different opinions. Uh, but I do wonder if over time we're sort of making progress, towards managing, risks, I would say fat-tailed risks, right? The rarest risks, because
Hmm.
those are the ones that matter, right? Yeah.
Yes, exactly.
So, okay. So as we get a little bit later into the book, we start to talk about some of the, I would say, issues with pension funds, which is something I found kind of interesting, and it kind of has a lot to do with the nature of taking risk and reward, right? And this is something that Mark Spitznagel always talks about, which is, I think, a tough concept to grasp, but it's an important one. You don't want to take too much risk that you blow up, but you can't take too little risk if you need to provide a return for your pension funds. So I know that's something you talked about. Do you have any further insight in it or any thoughts?
Yeah, I mean, it gets to some of the core tenets of modern portfolio theory that you know returns are risk adjusted. It's something that is really it doesn't make a lot of sense, like common sense, but it's very tricky. So what a lot of hedge funds try to do is, look at the volatility of various assets and optimize a portfolio that can provide a certain uh, kind of return for their client, and they can adjust that for, depending on who the client is. Pension funds tend to be fairly risk averse, so what they end up in is these portfolios that dials down the risk quite a lot by putting a significant part of the portfolio into something that's has very low volatility, like bonds. So this is why many pension funds have been put into these so-called 60/40 portfolios over the last couple decades, which is, when you read Mark's analysis of that, he claims, and he has the returns to show what he's saying is true, that the strategy is leaving a lot on the table because you're taking a huge amount of your portfolio out of the stock market, which provides the most returns over time. But it also has this risk of an extreme loss, in periods of 10 years in between. They don't come along very often, but when they do, they can be very devastating to portfolios. And this is what happened to many pension funds in 2008. Like CalPERS, which is one of the funds that I write a lot about in Chaos Kings, because they did make a sizable investment in Universa. Um, so the portfolio that Mark recommends it's really fascinating, I think. It's a 97% exposure to stocks through maybe like a S&P index, and then a 3% exposure to Universa, and that allows you to get exposure to the market, and it's going up most of the time, while reducing your exposure to the extreme events. The idea is that the wobbles, the 5-10% wobbles, don't really matter to your long term compounding return. It's the big crashes, the black swans, the extreme events that you should really care about. And that was the innovation, frankly, that Nassim brought to thinking about financial markets back in the 1990s and 2000s with books like The Black Swan, which is most people on Wall Street like to ignore the tails of the distribution because they're rare. They also can mess up your models because they can have these events that shouldn't really occur, or could only occur every 10,000 years or so. What Nassim's point was is that that is actually the place that you need to care most about, and protect yourself against. And that's what the innovation of the Empirica hedge fund was. And then after Empirica shut down Universa.
Yeah, and so I would say, I mean, I think in general, Wall Street in a lot of senses it's about gathering assets, right? And performance is sort of just not. as important over time. It's more like I can get some money in, and if most of the time I don't show extreme losses, then it's good enough. And I think that's if you coupled it with Universa where they show small losses, it's just not really comfortable to a lot of people. So
Yeah.
I just wanted to give one analogy too about risk reward. When we're talking about modern portfolio theory, which I admit is a boring subject, but so what they're trying to do is essentially say Mark is saying, well, I want to if I can fly, we can fly planes like a passenger plane 600 miles an hour because we can cost effectively reduce the risk of doing it, right? So we essentially can fly faster, right? And I think that's a good way of thinking about what they're doing. Now, what other Wall Street
Mm.
is doing is they're saying, well, uh, our solution, we're supposed to fly faster. We want to make a return, but but instead of doing that, we'll actually fly slower, right? So it doesn't really, it's not a congruent way of doing things, right? So it's like they need to take risks to get a return, but their solution is to take risks down. So it'd be like
Yeah.
we need to fly to London in 4 hours, and Wall Street saying it's like, cool, well, we'll fly to London in 6 hours, and that would be like having a bad return on your investment. So it's a really deep problem, especially for pension funds that are have a lot of people's money at stake, and that's they're underfunded. So it's a risk that is out there for a lot of retirees and other stuff like that.
Yeah.
Okay, okay. So I'm going to shift gears a little bit and just go towards a little bit towards some of the environmental, stuff you talk about climate change risks in the book. And I know a lot of people, I think, say, uh, this is not our thing. Who cares about the climate? But I want to say in the book, I think you make a really compelling case that these are existential risks, and we have to do something about them. But especially in the U.S., I think we're resistant to do that. So, do you have any more thoughts on that, even outside of the book or stuff you've left out or anything?
Yeah, I'd love to talk
Okay.
about that. It's kind of funny because there are some people that read it and they come across me writing about climate and say, "Well, wow, he's getting really political," and I think that's kind of funny because there's nothing political about it. Although you know there there are uh, there are political elements to it in terms of who thinks it's a problem and who doesn't. But to me, it's a matter of science. It's what I cover at the Wall Street Journal is climate and finance, and there's just a ton of money going into it. It's it the J.P. Morgan, BlackRock, biggest banks in the world. There's a section in the book where I have a European money manager from a very large fund, one of the largest in the world, testifying before Congress, and he's talking about how this is a green swan event, climate change. People can capitalize on it and make money from it because you're looking at the massive transition of the entire world's energy infrastructure. Um, so there's that side of it, and that's I guess you could say a positive black swan for people that are able to see what's coming, and there's going to be a lot of money made. And then there's the left tail black swan side of it, which is uh, potentially devastating economic and environmental impact. Some of which we're seeing right now with these heat waves all around the world. I wrote a story about that last week for the Wall Street Journal about how there are severe economic impacts to such events. You can have blackouts of energy infrastructure, and then there are just the little sort of unobservable things that happen to people, like small businesses that have to shut down. Um, yeah, I mean, to me, it fits squarely within the major themes of the book. The second half of the subtitle is the new age of crisis, and there are a lot of different components to that. It's not just climate. I started writing the book in 2020. as the pandemic was shutting down the global economy. And it's widely thought that we're going to see more of these events for a couple of reasons. One is that transportation is causing these deadly viruses to travel a lot more quickly than they used to. And we're also seeing climate as an impact. There's parts of the Siberian tundra that are melting. The permafrost is melting, and there's concern that there could be pathogens that have been frozen for tens of thousands of years that escape. So you have these interlocking events, overlapping events of these extreme risks that magnify and can create even as they create ripple effects, make things even worse. So I didn't want to write like a doomsday book. I mean, the whole point is to get people to think about like a universe strategy, how can we think about protecting ourselves from these things? And that's how I get into, as I was researching the book, I came across this paper that Nassim co-wrote about 10 years ago called The Precautionary Principle. And in that paper, one of the co-authors was Rupert Reed, who's a environmentalist in the UK. He's one of the founders of Extinction Rebellion. There's another author of the paper is Diedre Sornette, who's one of the world's leading complexity theorists. So these are serious people, and what they're trying to do in that paper is outline ways to think about extreme events and areas or risks that you should apply the precautionary principle to, which is something that really, it's that way of thinking is a little bit more common in Europe, but not so much in the U.S. And there are a number of different properties that they look at these different events. One of which is, can it have a global impact? And I would say that climate is one of those areas that yes, clearly it's called global warming. Can it does it have exponential properties? Like can it create risks that are sort of unquantifiable? And I would also say with climate, yes, that's something that we need to be concerned about because there are these feedback loops that happen with climate, and like heat is a very good example of that. It's you know contributing to forest fires, like we're seeing in Canada. I live on the east coast of the U.S., and we've been living with these smoke plumes coming down on top of us all summer. Um, those fires are releasing gigatons of CO2 into the atmosphere, making things worse. So there's these self-reinforcing effects. So Nassim, on top of the precautionary principle paper, he and his co-authors also wrote about the risk of climate and extreme weather events. And they say we only have one planet, and so we need to reduce these CO2 emissions.
Exactly. And I think that's, you know, it's probably the most complicated risk management question of all right now because we all want to consume, we all want to buy a new car. We all want to maybe travel the world, in airplanes that, spit out a lot of fossil fuels and stuff like that. And we just don't really know what the limits are to, our environmental risk, to planetary disasters, stuff like that. But it's like, the old saying is like in order to succeed you first have to survive. I think that's what Nassim always says, or Warren Buffett says, on average don't cross a river at 7 feet deep. I can't remember that. Maybe I'm confusing them. So the so so
Yeah,
so the
yeah.
point is though is we want to be able to enjoy life, enjoy the world, and get out when we want to do it. But at the same time, we can't take so many risks that the next day will be, game over, right? And and this is completely different than say the stock market, which is risky, but you talk about in the book the difference between like a probability of the ensemble and probability of the individual, right? And so
Mhm.
if the individual goes down in the stock market because its portfolio, they have to sell at a bad time. That's not going to matter. But in this case, we're talking about the planet, having big problems. And there's just no consensus really about what to do about it. Um, so that is something though that the reinsurance business I think is sort of working on, and uh,
Mm.
incidentally too, as you think about Universa, I mean, they're in the insurance business, which is sort of different than the rest of Wall Street, where you're dealing with premiums and stuff like that. So it's kind of a really you know different strategy, and different way of approaching risk or whatever. Um, okay, so let's talk about. I know the book deals a lot with the complicated question of small losers, right, in trading. And do you think there's any hope of people
Hmm. Yeah.
actually developing the average guy ever getting a feeling for taking small risks and taking small losses? I'm pessimistic, but I'm just curious.
I share your pessimism, uh, but it's something that I talked with my editor, in this book extensively, and I repeatedly bugged Mark about that. Is what can the mom and pop trader learn from this? Um, and is there a strategy that they could use that could be sort of like a mini Universa? And there just isn't. I mean, this is a professional fund with decades of experience. They were professionals with decades of experience when they started off doing this. It's don't try this at home. I would say, not that people can't. I think that the takeaway for investors is that I think it can give them a better way to think about the market, and that there are these extreme events, um, and it's just really hard. I think that the lessons really should be learned by Wall Street and professional money managers. That's kind of who I was hoping uh, would take away some lessons from this book. Not so much investors sitting home with their interactive brokers account, because it's expensive. To buying these options. Um, First of all, I don't even know if you can get the kind of options that Universa buys on an interactive brokers account. These are very exotic. You know, Positions that virtually no one would ever want, because they they are pricing in a decline of the S&P 500 of 20% within a month, which is extremely obviously extremely.
Hello, hello, hello.
Sorry, Scott. Sorry, can you hear me?
Yeah, I can hear you.
Yeah, somebody just called me on my phone. So, um, but I think that for everyday investors, it it seems like the record shows that the best strategy is to just buy the S&P 500 and sit on it, and you know uh, don't worry about it, because over time that's really the most successful investment.
Yeah.
Um,
So I have a comment about that, and I think with what Universa does, and this makes a lot of sense, is they want to have most of your money in a passive strategy, right? That doesn't move a lot, right?
yeah,
That's because then they reduce fees. They're not trying to beat the market by picking stocks, and then they have a very small allocation to like a tail fund, which they really really know how to do, right? But that piece
yeah,
is so small that they have that big chunk of passive money that isn't trying to pick stocks. It's just I'm assuming that's what they want to do, right? They're just saying is we want to ride the market as much as possible, and then we focus
yeah.
on on their tail payoffs, which are really small and explosive, and so that's a unique approach, right? And they
Yeah, exactly. And contrary to the 60/40 strategy, which is you're leaving a lot on, in bonds, you're not getting that upside in the market. So if you had, I'm sure there were a lot of people that, I was actually one of them who switched out of stocks in early 2020. I did not completely, but um, you know that strategy, trying to time the market, missed out on one of the biggest stock market rallies of all time. So that's what they allow their clients to do, is to get the most exposure to the broader market, and not try to pick stocks, not try to time, when things are going up or down.
Yeah, and I think one of the craziest things too, if you look at, if you look at a chart of the market post COVID, it is just gone. It went ballistic. So, if you got forced out at the wrong time, it's a big problem, right? Because all of a sudden, you see the market was up maybe 30% higher than its pre-COVID peak, not long afterwards. So it gives you an idea that getting forced out and then being able to force to chase, is a really, what you don't want to have to do, right? And over time, the numbers are really big because, one crash, and all of a sudden, you're going to be working for an extra 6 years, right? And that's, I
Yeah.
mean, if you talk to people after, I remember talking to people after 2000 and 2008, multiple people told me that. So it's a significant problem. You don't, all of a sudden you go, well, I'm caught out at a bad time. I'm retiring in 7 years from now, before, later. So it's, it's a
Yeah.
really big, really big problem.
Yeah. And that's what the strategy allows uh, investors to survive through, like in early 2020, and not have to be forced out of your positions because you've got a sudden, insurance policy payoff that you can use if you are bold enough to buy uh, stocks when the market's down a lot. Um, but then also, if you're concerned about the market's performance, and if you don't have this strategy, you might diversify into something like bonds. This lets you stay in and get that upside and not have to worry about a market crash.
Right. So do you think that there are tail hedge fund competitors coming online, or are they still staying away?
Well, I think that it's sort of a repeating pattern where after a crash, you see a bunch of money jump into it and start selling it, marketing it. Um, there are a number of hedge funds that have these tail hedge strategies as like a portion of what they offer, and some quite large, like Saba, the Boaz Weinstein hedge fund, is one of them. Uh, but typically, what happens is, after a couple years, clients lose interest, or the fund loses interest because it's just a dead weight and they're losing money. And it's a problem that Mark um, has encountered a lot over the years. Especially, I write about how when he launched Universe in 2007, he traveled all over the country trying to sell it to investors, and no one no one bought it. No one invested except for the first seed investors when he launched. Just because it's such a weird strategy, that doesn't fit within standard models of portfolio theory. It's very, very volatile. It's loses money consistently for years. That doesn't, with the Wall Street has a incentives for um, traders that last a year. They're aiming for a annual bonus. And if something like there's something like this, it's going to reduce their returns. It's going to mess up that bonus. Um, they're looking to try to get investors to think over the long period, years and years and decades, which is just not how many people think about investing, unfortunately.
Right. Okay, so I think we got about 10, 15 minutes left. I want to see if maybe I could let a couple of people ask questions. Is that okay, Scott? If I can get some people asking questions, let them in. Let
Yeah,
me
yeah.
see. Hold on one second. Let me. Is someone, if anybody would like to, send me a request for a question, I think I can let you in. Okay. Okay. I see someone like Jordan's got a question and Will's got a question. Okay. Let me see if I can let them in here. One second. Let me. Okay. Add a speaker. All right. Here we go. Okay. Will, you're on. Okay. So go ahead.
Hey, appreciate it, James. And this has been really interesting. It's really more of a comment, just praise for the book. Found it to be just absolutely fantastic. And one of the things that I thought was really really great was the chapter that you gave to Yanir Baryam. I think he's a guy who Nassim has worked with quite a bit over the years. They really are a dynamic duo, and to
Hmm.
kind of give folks some of the background of what he's done over the years, especially working with the U.S. government on Ebola, trying to help on COVID, and then other issues actually related to weapons of mass destruction, which obviously is up there in terms of high risk stuff. So, Scott, really appreciate this book. I think it's something that a lot of folks that I work with, I think it's going to be useful for them. I think it kind of gives you, a little bit of entry level into this world of risk and understanding, the phenomenology of these types of events. So just kudos. Really appreciate this.
Yeah, thanks a lot. I appreciate the thumbs up to Unir. He's definitely one of the biggest brains I've ever talked to. Quite intimidating, actually. I had a number of calls with him, and he's the real deal for sure. He's one of the leading complexity theorists. Some say the leading complexity theorist. Not a household name, of course, but I really loved um, the character interaction of Nassim working with Unir, and then Rupert Reed, uh, who sort of first introduced the precautionary principle idea to Nassim in a pub in East Anglia over whiskeys. Um, yeah, it's just they're really great characters and fascinating people.
Okay. I'm going to let Jordan in. He's got a question. All right. Jordan, you're here. Go ahead. Can you hear me? Jordan? Connecting. There we go. Jordan, you got a question?
Yeah, thanks a lot for doing this, and kudos to the book. Absolutely fantastic read. And I was actually a little surprised about the climate change and how interesting that conversation was. So my question really was, in your conversation, how do you talk about climate change and not make it political? And what I mean is, the models are wrong. Models are never good for long-term forecasting, but as the precautionary principle would say, if we don't know what's happening, let's not pump a bunch of shit in the air. Um, so
Yeah.
how do you talk to people about climate change without making it such a left versus right political issue?
You really can't,
Yeah, I was
unfortunately,
wondering.
with at least with some people.
Yeah.
Um, you know, they hear and they just think, oh, this is wacky environmental stuff and it's a hoax. Um, but it's a good point about the certainty uncertainty issue, which is it's a really interesting way to think about it because a lot of climate skeptics, and even some fairly sophisticated ones, point to the uncertainty of the models and say, well, the uncertainty is why we need to stop and assess the situation, really think about it, try to get more clarity before we do anything drastic. And what the precautionary principle shows is that's got things backwards. If you're uncertain about the risk of a potentially existential event, like climate change potentially poses, do not take the risk. Like Nassim says, if you're uncertain about the pilot, don't get on the plane.
Yeah.
Um, and so it flips the uncertainty around. Um, and I have to say though, the models at least some of the models predicting temperature increases have been pretty accurate.
No,
We're
those ones I think are, but a lot of times they'll try to be
Yeah,
specific. And I'm in the Seams Real World Risk Institute. Actually, we're finishing up tomorrow. But I'm a
yeah,
small newspaper publisher, and I also run grass-fed beef. And I live in a very conservative area, so I'm always trying to say, hey, look, lower inputs, we're building more soil. I always expected conservatives to sort of be like, cool, but instead they just go, oh, you environmental, leftist liberal, uh, for just raising grass-fed beef, and I've never been able to find a way to communicate effectively between those two camps.
uh, well, you might want to ask them if they want us to lose out to the Chinese
Oh, good
when it
point.
comes to all this clean energy stuff, because they've been kicking our ass for the past decade.
Yeah.
They lead in everything, and solar, wind, batteries, EVs, even with Tesla, they're way ahead of us. Um, and it's the way things are going. I mean, wind and solar is now cheaper
Yeah.
than any other competing power generating resource. So,
Well, and actually in our
uh, you
area
know,
here in Colorado, we're already half solar and wind because it's such a, we have the sun and we have wind here in Colorado, but it's a modular source of power, which is the second you get the
yeah.
basic infrastructure, you can keep adding on compared to say like a coal power plant or something like that, where it has to be a lot bigger. But anyhow, thanks for a great book. And James, thanks for letting me have this opportunity. So appreciate it.
All right, no problem.
Yeah.
Does anybody have a question or two left? We got about maybe 10 minutes or so. Anybody? Pedro's got one. All right, cool. All right, Pedro, go ahead. Hello. All right, go ahead.
Hello, can you
Yeah,
hear me?
yeah.
Okay. Yeah, thanks a lot. Yeah, thanks a lot for doing this. So I haven't read the book yet, I have to confess. But I do have a question for either one of you. Is there any takeaway for retail investors? And, I mean by that in that, if you're not a billionaire who can use Universa, I mean, are there alternatives to tail hedging? For someone who just invests in indices? Do they ever talk about it? Like, I mean, does it ever come up?
Well, I think we talked about this a little bit earlier. Like as Scott would say about from retail or from Mark's perspective, he says no. So uh, my perspective is some of their like, but this for me is some of their basic strategies are sort of known. Uh, but again, they're not a walk in the park to execute yourself, right? So that's just kind of the way it is. Uh, but the basics of working with some tail strategies with options aren't impossible. It's just that Universa has better people doing them, right? So I think that would be my answers. Scott, what's your answer?
Yeah, I mean, it's I would say just inadvisable. So there are ETFs, and I mentioned a few of these in the book that are trying to sort of replicate a universal strategy. Um, the last I've looked, they were not doing that well. So they're called the Simplify uh, ETF, Simplify U.S. Equity Plus Downside Convexity. It's a ticker is SPD. Ex Pimco ETF manager launched this a couple years ago. I talked to him. It was all interesting stuff, and they're implementing some new rules that have been passed by the SEC that allowed ETF managers to replicate hedge fund like strategies. So using derivatives. My guess is that it's just so expensive to you know to implement this strategy if you don't really know what you're doing that it's um, I don't know how well it's going to do, and it hasn't been tested yet in a crash. So, what you're going to just see is just constantly diminishing returns as it spends through investors' monies buying the options to implement the strategy. But that is one place that I found that a retail investor could look to try to replicate something like this is these ETFs, and there's others besides the Simplify ones.
Okay. Got it. Thanks.
Okay,
Hey, I did have another question here, James. This
okay.
is Jordan again.
All right.
How hard was this book? How hard was this book to pitch to the publishers? Was it hard at all, or was it a bit of a sell because it's kind of a different book in the scheme of things?
I think that my editor likes that it's different. You know, they tend to not, you know, I mean, publishers have a lot of, you know, different motivations or, tactics that they use. Some, like, I felt like my first book, they kept thinking about it in terms of what other books like it look like. Um, but I think at the end of the day, it was, I was able to get Mark and Nassim to agree to talk to me and work with me on the book, and that was a
Yeah,
big
that helps.
selling point. Yeah,
Yeah.
yeah. I mean, I've known Mark and Nassim since 2007, so we go way back. So, Nassim wasn't too keen on it at first, I have to say. Um, he's not a fan of the narrative fallacy. Um, and so he was like, I don't want to be one of these, fucking Michael Lewis books. Uh,
That's great.
which
but
is a
but
reasonable concern, I would say. So
yeah, yeah,
anyway, go ahead.
yeah. But I think that it was I think the idea that it was compelling was in 2020 as I was working on the pitch and talking to the editor was it did seem like the world was sort of unraveling around us, and with the street protests, with the political scene in America, it's quite unnerving. The pandemic, then Ukraine happens. Like it sort of felt like this is an interesting way, a lens to look at, not just what's going on in the market, because we also had this like epic market collapse, but what else, how can we create a narrative that allows me to write about all these different things and that seem to be pushing the world to the edge. Now I feel like things have stabilized a bit since then, but I think it's good to try to remember how things felt back then because we're going to see, these extreme events return.
That's what I really liked
I
about
mean,
it. The fact that there's a little bit of space since 2020 that now there's a time that we can have a little bit of rumination. So I thought the timing was what made that book so unique that when I heard about it, coming out.
yeah, thanks. I mean, we've got bombs going off around a nuclear plant in Ukraine, so you know, it's like these things just kind of often just hit us in the face when we weren't least expecting it. And you always kind of wonder like what's the next shoe that's going to drop. We got a pretty scary election coming up in the U.S. Um, that's something I've got my eye on.
Okay. All right. So I just added one other person.
Yeah, I have a question.
For final,
Thank you
it'll
so
be the
much,
final
guys.
question. We'll let Scott go. All right. Go ahead. Go
Okay,
ahead.
thank you, James. Yeah, I just have a question. I'm a young trader, young writer, and I admire you guys for what you're doing. I'm just really interested in trying to predict not exactly black swans because you can't predict them, but as I understand them, they're more of a spectrum of like from black to gray to black, and for example, one of my very first successful trade was trading the Brexit. And as a retail investor, I found that the VIX could be an appropriate tool or option to use those events. I just wonder, in your book and in your profession, how interested are you in categorizing the different levels of predictability of the spectrums of let's say swans?
Yeah, I mean that's the area where Didier Sornette, that those are the waters he swims in, is the various areas of predictability. Now, I mean, I think it's something that sort of drives Nassim insane, because the black swan idea is it's a bit fuzzy, because it's like he'll say 9/11 was a black swan for the pilot, but not for the terrorists. It's a tricky concept. It depends on your perspective. So he would say 2008 was a gray swan because there were a lot of elements of it that were predictable.
Yeah.
Like as I write in the book, he had identified Fannie and Freddie as a potential catastrophic event. And they weren't alone. I mean, I remember I was covering the markets back then. There were a lot of people looking at Fannie and Freddie saying these things are going to blow up. And I think it's also what bothered Didier about the black swan concept is that he believed it gave people the ability to shirk responsibility for the destruction that they had wrought on Wall Street, because they could just say, well, this thing was unpredictable and nobody could see it happen. But it's this continuum, it's a spectrum between these different kind of swans. Brexit, if you were able to predict that, congratulations, because I certainly did not see that coming. I was actually covering that in the UK at the time, up in northeast
Oh yeah.
UK. And I was very shocked by that.
Yeah, the demographic is what tipped me off, because older people were voting more and they were leaning towards Brexit, and the polls were really tight. So that I thought was, and the other thing is that volatility was very low, and such a big event I thought would spike volatility. Of course, there was the trade with the pound, but I mostly focused on the VIX. But but I see what you mean. Like even with Nassim Taleb, using like a really good example of 9/11 as being a black swan, like it's still a spectrum, because like there's been terror events before. I feel for it to be a total 100% black swan, it would need to be a whole new category, like something that's unheard of, as like natural disaster is a category, or terror attacks is a category, but then something that we don't even know exists would be 100% a black swan.
Yeah, the unknown unknowns.
Yeah, exactly.
Okay, everybody. I promised Scott and I kind of had an agreement around now to wrap up, so I think that's been good. Is that good with you, Scott?
Yeah. Thanks everybody for listening.
Okay. I wanted to say thanks to everybody for listening. I really, really appreciate it. And go buy Chaos Kings. And if anyone happens to be in Northern Michigan this weekend, I'll be up there. So hit me up for a beer. All right. Okay. All right. Bye. I'll talk to you guys soon. Thanks for coming. Bye.